All right, guys, without further ado, let's jump straight into the keynote of the digital finance track. The presentation by World Bank will look at the evolving nature of digital financial services in Malaysia and the East Asia and Pacific, as well as some of the challenges, opportunities presented by the COVID-19. Rekha Reddy is a financial sector specialist, World Bank Group's finance global practice. Rekha joined the World Bank as a young professional. Since then, she has managed assistant lending operations over lending operations in over 15 countries. Sorry, I had to read that again. 15 countries in Latin America, Asia, and Africa. Guys, here is Rekha Reddy of the World.
Nama saya Andi, saya berasal dari kota Malang, dari Jawa Timur. Saya bekerja di ladang di sini, dan kebetulan kalau di ladang kita susah untuk mengirim uang. Tapi sekarang saya lebih mudah mengirim uang dengan aplikasi di mobil saya, karena dengan mengirim uang pakai aplikasi ini, uang kiriman saya cepat sampai dan saya bisa melakukan di mana saja, di manapun juga.
Hi, I'm Grace from Philippines. I came here in Malaysia for working as a caregiver. My place in the remittance is very far, so I need to take 15 ringgit grab car or taxi. So when I find out the mobile apps, my money I save a lot.
Nama saya Siti Juwita, berasal dari Medan, Indonesia. Alhamdulillah, saya dapat membantu keluarga saya di kampung. Satu saat anak saya sakit dan sangat-sangat memerlukan uang, saya tidak dapat kedai yang ada lesen. Pernah saya menghantar duit tapi tidak sampai dan duit simpanan saya habis. Alhamdulillah, dengan menggunakan aplikasi ini, saya boleh menghantar duit bila-bila masa.
Terima kasih Greenback.
Thank you Greenback. Terima kasih Greenback.
Hi, I'm Rekha Reddy, Senior Financial Sector Specialist at the World Bank Group. I'm very happy to have the opportunity to address you today at the Star Business Summit. For more than a decade, we've been talking about digitalization of financial services, its potential to increase efficiency and lower costs of transactions, and how that'll affect the trajectory of the financial services industry, the value proposition for the banking sector, and the economy more broadly. But then COVID-19 hit, and multi-year plans for digitalization of financial services have been accelerated due to restrictions on transacting flexibly. And the mindset of many businesses and individuals with respect to digital financial services has changed. In my address, Inclusive Digital Finance in Pandemic Times and Beyond, Challenges and Opportunities, I'll look at the nature of inclusive digital finance and how it has been evolving in recent years, and also at the actions and policy frameworks needed to catalyze responsible growth of digital financial services during this pandemic period and beyond. Here's an outline of my presentation. First, I will look at what financial inclusion looked like globally and in the East Asia region in recent years prior to COVID-19, gaps in growth using international benchmarks. Then I'll look at the pandemic period and how these COVID-19 conditions have provided both challenges and opportunities for the expansion of digital financial services. Then we'll look at digital financial services and how they can help the goals of financial inclusion and economic growth. And finally, we'll conclude by looking at emerging trends and policy issues to consider to leverage the healthy growth of digital financial services. So let me start by looking at the panorama of financial inclusion before the COVID-19 pandemic hit. Financial inclusion is clearly on the rise in Asia. 71% of adults in East Asia and the Pacific have an account. That increased from 55% in 2011. These are 2017 data from the World Bank Global Financial Inclusion Database, and we're looking forward to having new World Bank globally comparable data in 2022 as the process of gathering new data in 100 plus countries concludes. But in the meantime, you can see here that there's a wide range of financial inclusion across countries, ranging from 22% in Cambodia with a financial account to more than 80% in China, Malaysia, and Thailand. Similarly, in South Asia, you can see a large increase up from 32% in 2011 to 70% in 2017. Nearly 300 million accounts came from India alone, largely due to a government policy to expand financial inclusion through biometric identification and smart cards, achieving 80% account ownership. Yet many Asian adults remain unbanked. You can see globally that 1.7 billion adults are unbanked. Unbanked here being defined as lacking an account at a financial institution or with a mobile money provider. We can see that nearly half of the unbanked adults live in 7 economies, the majority of them in Asia. China, India, Indonesia, Pakistan, Bangladesh, all Asian countries with a high percentage of unbanked adults. And the unbanked are typically younger, less educated, female, or poorer. In East Asia, women represent 54% of unbanked adults, and over half of unbanked adults live in the poorest 40% of households. In East Asia, excluding China, 55% of unbanked adults have a primary education or school education or less. Why do some people remain unbanked? Globally, insufficient funds, that is, having too little money, is the answer most commonly stated in surveys as the biggest barrier to account ownership. This holds true in East Asia and Pacific, which you can see on the left-hand side of this chart, where you can see that the most common reason after insufficient funds for not having an account is the ability to use someone else's account or lacking the required documentation to open an account, or for the financial services being too expensive or too far away. Some of these challenges won't be able to be fixed with digital channels. If you lack the appropriate documentation or ID to open an account, a digital channel won't fix that. But having a digital channel at your fingertip could increase the value proposition of a financial account to someone who feels that they have too little money for an account to be valuable, or for someone who finds that financial services are too far away to be cost effective. So let's look now at Malaysia. How do they compare in financial inclusion with respect to international benchmarks? The answer is pretty well. Most Malaysians report having some form of financial account. In 2017, 85% had an account, which is well above the benchmark for the East Asia Pacific of 59%. On the right-hand side, you can see that even digital payment use compares favorably with countries that report a relatively high level of financial inclusion. At that time, Malaysia had higher use of digital payments than in Brazil, China, and Thailand, though slightly lower than in Kenya and Russia. So we can look now at some of the challenges and opportunities brought by the pandemic. COVID-19 conditions have clearly accelerated digital transformation. Results from a global survey of companies showed that 97% of enterprise decision makers believe that the pandemic sped up their country's digital transformation. 79% said that COVID-19 increased the budget for digital transformation. And in the finance industry specifically, COVID-19 accelerated digital communications of companies in the finance industry by over 5.6 years relative to their initial strategy. This indicates that banks and other financial institutions are capitalizing on the increased willingness of customers to transact digitally. On the challenge side, pandemic restrictions have lowered economic activity, making it more challenging for to achieve profitable volumes for financial transactions. But at the same time, they give urgency to eliminate cash transactions. Winston Churchill advised that we should never let a good crisis go to waste, and pandemic conditions provide an urgency to eliminate cash transactions. These three figures on this page show that hundreds of millions of people are still transacting in cash. On the left-hand side, we see 235 million who are receiving agricultural payments in cash. The middle shows the 100 million unbanked receiving government payments in cash, and 260 million using cash of the unbanked using cash for remittances. These are all opportunities to support transition to digital means globally, and COVID-19 has made it urgent that these transactions become much more efficient and safer. In Malaysia, is there room to grow digital payments? Historically, we see that there has been space to expand digital payments, particularly for the bottom 40% and other vulnerable groups. Just 61% of Malaysians in the bottom 40% have made a digital payment in the last year, while 39% of Malaysians with primary schooling as the highest level of education use digital payments. Those numbers have very likely improved in recent years, but there's no guarantee that any improvements are concentrated among the most vulnerable, meaning that we need to continue to guard against the digital divide. When we have new data, we'll be able to see how payments behavior has evolved during the pandemic. The figure on the right-hand side shows that in comparison to East Asian neighbors or other upper middle income countries globally, Malaysians were less likely to have used cash for wage payments and utility bills. However, in 2017, more than half of all Malaysians paid cash even for their internet purchases, much higher than in other upper middle income countries. We also see that during COVID-19, firms have increased utilization of digital platforms. During the pandemic, World Bank Business Pulse survey data from 2021 show that 57% of Malaysian firms report investing in digital platforms. This is higher than what we see observed in the Philippines and Cambodia and Mongolia, but below what the levels reported in Vietnam and Indonesia. We're also seeing studies beginning to roll out about how various sectors responded during COVID-19. On the left-hand side, we can see that in China, transaction volumes of QR code merchants actually increased during COVID-19 in various regions. Researchers there looked at two different periods: before January 2020, when the pandemic, which is the agreed upon date for when the pandemic hit, and after. The red solid line shows the weekly actual standardized business volume in 2020, and the black solid line shows the same indicator in 2019. They were able to look at the counterfactual, that is, assuming no COVID-19, and that's represented by the red dotted line, and see an increase in digital transactions. Meanwhile, in Africa, we can see that in Rwanda, the value and the volume of person-to-person money transfers during COVID-19 also increased. There, we look at the cutoff date of March 2020 and can see that transactions increased almost 400% in the initial weeks following news of COVID-19, also accompanied by an enabling environment, including reductions of fees to incentivize digital transactions promoted by the central bank there. Let's take a look now at how digital financial services can help. Digital financial services can benefit both financial institutions and customers. First, there's the element of improved customer experience and bringing people in who were formerly excluded. Remote access, convenience and security, tailored financial products and services, and an opportunity to build financial history within a system are all attractive benefits of digital financial services. There's also the opportunity to increase revenues. With digital financial services, it's easier to expand customer bases to include new and remote areas, to provide products to new market segments, including the unbanked, and cross-selling opportunities. There's also the reduction in costs, lower delivery and channel costs, and also a reduction in cost of funds. That could be from deposit gathering or capital markets funding from digital channels. And lastly, there's the element of strengthened risk management. We find that it's easier to gather more data and automation for credit underwriting, portfolio monitoring, and collection when you have all the data available in digital form. There's also efficiencies from straight-through processes, reduced error rates, investigations, and rework. Evolving technologies also have a huge potential to expand financial inclusion. On the left-hand side, we can take a look at a variety of technologies that have been used, such as mobile technologies, distributed ledger technology, blockchain, crypto assets, APIs, open banking, digital ID, biometrics, artificial intelligence. These all have had a transformational effect in various countries on new business models, new entrants, more accessible and cost-efficient services, and on leveraging data to tailor products, with an eventual impact on access, commercial viability, relevant products, and safety and customer knowledge. The traditional mechanism of mobile phones also have a high potential to reach the unbanked. 2/3 of unbanked adults were reported to have a mobile phone, and this has likely increased significantly in the last few years as the cost of phone handsets and data have continued to become more affordable. However, the challenge remains that in many countries there can be a mismatch between access to telecommunications and smartphone devices versus the digital channels that are developed by financial institutions. In some, the user interface provided to the client matters. Access to a phone means nothing if the platform for the user is not attractive. Digital financial services can also lower costs and increase efficiency for SMEs. Potential benefits again include lower costs, strengthen financial inclusion, and improve quality of financial products and services. But for SMEs in particular, the opportunities for automating internal processes, digitally interfacing with financial service providers, suppliers, and customers are also valuable. Finally, there's the increased availability and accuracy of SME information through expanded credit information sharing that improves the possibility of the SME to get credit in the future. And also, the enabling of responsible credit border data exchanges will continue to increase the availability of data across borders as well. At the same time, we're seeing new digital entrants coming in to disrupt the market. By 2020, over 300 million people around the globe were clients of digital banks. This includes WeBank in China with over 200 million customers, also Kakao Bank in Korea with 11 million customers, and Genius in Indonesia with just 1.5 million customers. As Malaysia is in the process of issuing digital bank licenses, the question is what can be done to grow this market sustainably and include sustainable financial services from these new market entrants. We can find lessons from Malaysia from other international experiences. Many digital banks are relatively new, and questions remain about how their developmental trajectory will evolve. There have been some early failures of digital banks that offer a cautionary tale. For example, Jinja in Australia, Bow and Royal Bank of Scotland. And at the same time that COVID-19 has improved the opportunities of these digital banks to capture new customers, it has also hurt some of their bottom line, many of their bottom lines, as transaction volumes due to reduced economic activity have declined. Regulators need to strike the right balance between facilitating entry of new financial service providers into the financial market and maintaining financial stability. They also need to look at various elements of factoring financial risk, non-financial risks, as including operational risks and business model risks, because digital banks are often more reliant on fee-based income than traditional banks. They also need to develop institutional capacities to understand and mitigate new sets of ever-evolving risks and to manage the digital divide effectively. Currently, most digital banks are catering to bank segments or to underserved segments, but those who have some level of financial access in most settings. Authorities are trying to use their licensing framework in many jurisdictions to use digital banks to initially push for increased access for underserved and underbanked customers. So what are some of the emerging trends and policy issues that one would need to address for healthy digital financial services? They affect many policy levers and objectives. Building off from lessons around the world, there are several steps governments, businesses, and financial institutions can take to further accelerate digital financial inclusion. They relate to the legal, regulatory, and supervisory framework, a close review of financial structure and development, analysis of digital penetration and literacy, and also physical, digital, and financial infrastructure, ensuring access to those elements. These are needed to ensure common policy objectives, including stability, integrity, consumer and investor protection, a level playing field, innovation, inclusion, and of course, market development. At the same time, digital financial services bring important policy challenges. One is related to the regulatory and supervisory perimeter. Fintechs are new animals for many countries, and they may not fit in with the current regulatory and supervisory boundaries. There also may be system and capacity constraints with respect to the ability for analysis of these types of institutions. For depositor and investor risk, there may be many different types of typologies of new providers with different regulations, supervision, and transparency elements. On the financial stability side, which has received a lot of attention of late, there's the element of unsupervised linkages, and also digital financial services potentially exacerbating credit cycles with their untested credit models, or affecting banking system profitability in unforeseen ways. On the integrity side, which is the anti-money laundering and CFT, some of the elements that we see are that access to customer information can lead to abuse without adequate consumer protection mechanisms. We also see that the cryptocurrencies like Bitcoin have been used for illicit activities. Vulnerability to cyber threats is also a key issue that can affect not just individuals, but also financial market infrastructures, financial institutions, and even authorities. And lastly, there's the issue of over-indebtedness. With new and easier access to digital credit, there have been cases of impulsive over-borrowing registered. And there's some studies that some of the problems associated with digital credit are that users do not fully understand the cost of borrowing and make these decisions very quickly. Poor disclosure and transparency, as well as aggressive market practices, exacerbate these issues. Customers need to build their digital financial literacy. In addition to over-indebtedness, low levels of literacy can also lead to disputed transactions, fraud, and vulnerability to phishing and malware attacks. Some of the elements of digital financial literacy include knowledge of digital financial products and services, awareness of digital financial risks such as online fraud, digital footprint and overborrowing, digital financial risk controls and how to do that, for example, by securing PINs, accounts, other personal information, and phishing, and also knowing your consumer rights and redress procedures with your various regulators. On the regulator and policymaker side, there needs to be a continuous assessment of evidence and a management of enhanced risks. On the financial inclusion side, we're always looking for evidence of positive impact of these digital financial services and how they differ from traditional financial services. We believe that there's evidence for a strong potential for digital improvements for MSME finance, capital markets, Islamic finance, as well as insurance or insurtech. Regulators and policymakers are busy monitoring emerging risks, and many have set up a framework, but enhancements have been needed. Most risks that already exist in traditional finance, but can be amplified by digital channels. And they're largely proportional, but challenges could be limited experience and resources with managing these risks, as well as cross-border regulatory arbitrage, which one can be unfamiliar, and then again, cyber risks, and also newer risks related to exclusion, discrimination, and privacy. With respect to data privacy, access to consumer information can lead to various types of abuse without adequate consumer protection mechanisms. There are also some risks of discrimination that can occur with algorithmic scoring models for credit. Due to the proprietary nature of these algorithms by financial institutions and the amount of technical expertise needed to evaluate them, it's hard for regulators to be truly equipped to evaluate them. Regulators and policymakers are also considering policy issues around data frameworks and central bank digital currencies. Who controls data has the competitive advantage, and that is ever more true in a digital financial world. Central to fintech, data frameworks have important implications for competition, privacy, efficiency, and inclusion. And who owns different types of data and under what circumstances of access is an increasingly important issue for various stakeholders. Frameworks need to cover collection, processing, storage, rights and obligations, individual controls, cybersecurity, and competition aspects. There's also global dialogue needed on issues such as data localization, which can be highly nationalized. There's been a lot of attention on central bank digital currencies, or CBDC. And in particular in Malaysia, there is the pilot with Australia, Singapore, and South Africa that we're eagerly awaiting the results of. For some countries, digital CBDC could pose risks for stability, and there are needs to assess risk carefully for global monetary system, anti-money laundering, and know your client, as well as various other areas, as is being done through various pilots. There's also the potential to support financial inclusion through CBDC, through cross-border payments and remittances. The case for CBDC is going to be a very context-specific one. Countries will weigh them against enhancements to existing arrangements, and it will likely be an incremental approach over time. Finally, let me conclude with the policy agenda promoted by my employer, the World Bank, in conjunction with the International Monetary Fund, the Bali FinTech Agenda. This agenda lays out the need for a balanced approach and identifies 4 broad policy challenges, including fostering it and these policy challenges are common to all developing countries. They include fostering an enabling environment to harness opportunities, strengthening financial sector policy frameworks, addressing potential risks and improving resilience, and promoting international collaboration. And with that, I thank you again for the opportunity to address you today, and this is the conclusion of my presentation. Thank you.
Hi everyone, thank you Rekha. I hope you enjoyed that presentation, and thank you again Rekha for the insightful sharing and for all of the information you've given us. And that was the keynote of the Digital Finance track of the StarBiz Summit.